Hello friends, welcome to this investment banking tutorial from WallStreetMojo. Let us look at the overall framework. We've learned what is research, we've looked at sales and trading, we've also looked at raising capital. So now we'll move to underwriting and market making. So these are basically two industry jargons which are very important for us to understand. When we talk about IPOs, what happens is, let's say if the company is wanting to raise $100 million, and if they're unable to do so, then what happens? There is a risk associated with it where we probably assume that the IPO may not be successful. To mitigate the risk, investment banks actually underwrite an IPO, which means that if there is an undersubscription, then the investment banks will actually buy those shares. Let's take an example here and understand this in a bit more detail. Suppose there's a private company, a small one, that wants to raise capital using an IPO. But the problem here is that there may be risk associated with undersubscription. Let's say this company wants to raise $100 million from the market, and the risk for undersubscription here means that they're not capable of raising what they want to raise. So not 100 million, maybe they are able to raise 90 million. So that becomes an undersubscription. So here, investment bankers who basically underwrite the securities will help the firm raise the committed amount. Here, the investment bankers virtually guarantee that the amount that is committed to be raised will be raised. And how does the investment bank actually ensures that? So when the IPO comes, the stocks are given to the investors, right? And let's say if there is an undersubscription of any kind, let's say to an extent of $10 million. So these 10 million worth of stocks get absorbed by the investment bank. And in short, the investment banks will actually buy these shares and sell them at an appropriate time to make a profit. So underwriting will mean guaranteeing that any amount of undersubscription will be absorbed by the investment bank. Now this absorption of shares involves a significant financial risk. The financial risk could be, let's say if the IPO was not successful, the investment banks may have to buy this stock to an extent it was undersubscribed. And let's say if the stocks tanked after some time, that's a huge risk for an investment bank. And that's why when we look at underwriting, investment banks actually charge a hefty fees during the underwriting scenarios. And in this process, they have to negotiate in detail with the risk department as well as the compliance department about the amount of risk or the quantum of risk that the investment banks can take with respect to underwriting. So with this, we have understood underwriting as one of the most important functions. Curious to check out the market making activities of the investment bank? Flip through our next video in this series. See you there.
Conclude today's discussion. A big thank you to everyone who tuned in from the Wall Street Mojo team. But hold on, the financial adventure continues. The next episode unfolds on Tuesday, and we're super excited about what's in store. Make sure to subscribe and turn on those notifications so you don't miss out on the financial insights coming your way. Until next time, this is the Wall Street Mojo team signing off. Stay informed, stay engaged, and stay Wall Street Mojo awesome.